In this episode, we're going to talk about how you can copy some of the trades or some of the investment of the best investors in the world. Sometimes maybe you find it a little bit hard to figure out what to invest in. You look at companies and it's not a great investment. You look at another one, it's not a great investment. How do you get inspired to find really good companies to invest in? Well, the thing is, the hedge funds of the world, they have to make it public what they're investing in. And we can look that up and get inspired. So that's what we're going to go through today. How do you look that up? What should you look for? And also I'm going to tell you just a little list of some of the investors you could decide to follow. Welcome to Money and Freedom, the podcast where you learn to become financially free using value investing. How do you do this and why? And let's just rewind a little bit. The hedge funds of the world, they have to report their trades to the U.S. Securities and Exchange Commission, the SEC. Now, the website of SEC, sec.org, I believe it is not super user-friendly. So you don't want to use that one. But there are other websites, and basically I'm already in step number 1, that you have to figure out how to look it up. There are other websites that make this information more accessible. And those websites are GuruFocus is one of them. That's probably the most known one. Then you have Dataroma, you have WhaleWisdom, and then you have StockCircle. Those are 3 examples. I'm just going to talk about GuruFocus a little bit, which is a really comprehensive site, actually. It can do a lot of things, and it wants you to subscribe and pay. So that's a little bit it's 2 drawbacks about this site. One, you keep getting this, please create a membership or log in or whatever. And if you don't want to do that, it keeps popping up all the time. Let's say you do subscribe, you become a member, then there's a lot of information on it. And I actually find that information is confusing to my students. So they'll say, we calculate this, but according to GuruFocus, it has a warning on this and it says it's worth this. I find that they get distracted and have a tendency to do whatever GuruFocus tells them to do, what the website tells them to do. I prefer that it's super clean, that you just know what the investors are investing in and not so much else, because then you can do the analysis yourself, and that's what I really believe you should do. So one website I like to use is Dataroma. And you can't really subscribe to it, but how they make their income is by ads. So there'll be some ads popping up sometimes, and so you have to live with that. But it's super simple. It will just tell you a name of the investors, and then it will tell you what they're invested in, what the portfolio is, the recent trades, and so on. And that's it. So I actually prefer that one because it's not that distracting. One thing to be aware of when you're looking up the portfolio, some people think that it's immediate, but of course it's not immediate. They're not required to, the funds are not required to register that information with the SEC all the time. It's not like every day they have to do it. They have to do it every quarter. And then there's a delay. So you'll see the trades of the last quarter, but you won't see them just when the quarter finish. So you have to keep that in mind, that things can have changed after they actually decided to invest in something. They might have made a new investment. They might have sold it. So you really have to be discerning when you use this information. So that was step number 1, how to look it up. Very easy to look up on these websites that collect the information from SEC. So the next step number 2, is you have to figure out which kind of investor are you dealing with here. So you have to kind of treat the data. There are 2 main types of value investors. And these value investors that are so famous, we call them in, this vernacular of the value investing world, we call them gurus. So there are 2 main types of gurus: quantitative and qualitative gurus. And what does this mean? Well, the qualitative kind of investors, they invest according to some kind of key number. And they can actually make a computer do the work. They don't even have to physically do it themselves or physically use a lot of brain power on it. And in a previous podcast, I went through one of these methods with Joe Greenblatt's magic formula. You can go back and listen if you're curious how this actually works. And with Joe Greenblatt, it was just two numbers. It was some kind of key number for profitability and another for the price. So, for example, it could be, you could use a stock screener like the one you find on Yahoo Finance and look up any number for profitability, for example, ROA, return on invested assets, or ROE or ROEC, whatever. You find one that you think is suitable. And the other number could be a number that reflects the price of the company. So that could be PE. And then you sort it, you make the screener tell you, give you whatever companies go below a certain number, above a certain number, and it will give you whatever, let's say 100 companies. And then you decide, well, every second month, I'm going to invest in 20 of the best. So that's the quantitative way of being a value investor. The qualitative way, you really look at the companies. You take them through a checklist. And this is the method that I really prefer myself. Well, what's the problem with the quantitative? And we can take an example from a different world. Let's say that you have a company and you want to hire someone. Let's say you use a quantitative approach. That means you would say, I'm going to hire the 10 best, and only measuring from two numbers, which could be, if we're making it a bit similar, it could be the ones with the highest grade average, that would be profitability, right? And then the ones that require the lowest salary. And then you just hire the 10 best of, scoring like that. Would you get the best employees in your company? Would you get the A players? Well, be lucky if you get one. Maybe you will get one. But you cannot be guaranteed you get any A players at all, because you're just taking grade and a salary request and and that's it. I would not want to run a company like that at all. We want to take the company through an interview in a way, a checklist. And in the show notes, you can download a cheat sheet of my checklist. You can frame it in gold, of course, a little gold frame. Hang it on the wall with a solid nail next to wherever you're sitting and investing, so you always know what to look for. Right now, I'm also developing a worksheet, which is a little bit longer and makes it easier for you to follow the process. I will also link that in the show notes. So, how do we know if it's a quantitative investor or a qualitative investor? You have to look at the numbers of companies they're invested in. And there is no hard rules with this, but let's say they have more than 100 companies in the portfolio. It's probably a quantitative person. And why don't you want to copy someone who's doing the quantitative way? Well, because they didn't really vet the company. They didn't take it through a checklist. And if it was hiring, they didn't even do the interview with whoever they were hiring. So you don't know if it's good quality. If you copy a quantitative, then, that's basically almost impossible, because you would have to buy all of it and you would have to buy it at the same time. And there's a lack in time, so we can't do that. We can use it to get inspired with the qualitative picks. How do you know if an investor is a qualitative? And now we're actually getting into step 3. And that is, you have to look at the composition in the portfolio, not just how many companies that they have. Some of the greatest value investors in the world have a very concentrated portfolio. And that means it's not just a question of that they don't have a lot of companies in it. Let's say they have, 50 companies, But some of them will take up a huge part of the portfolio. What does that mean? Well, it means when they're investing and they really believe it's a good case, they will go in deep. They will invest a lot in the same company. And, well, we can make a rule of thumb, but there's never a hard rule with these things. When we see an investor who has more than 10% of the portfolio in one company, we are probably dealing with a value investor that has a very qualitative approach to the investing, because 10% is quite a lot. Now, this is it's a little bit difficult because some investors will have a rule in the fund where they cannot invest more than 10%. So we kind of have to look at the whole picture. Does he have several that are close to 10%? That's probably, he's capped by that rule probably. So the thing about diving deep is we see this in the best investors in the world. For example, Warren Buffett, right now, as we're speaking, he has about 1/3 of his portfolio of public companies in Apple. And he sold a lot already. It was actually more than half of the portfolio. And if you think about that, how crazy is that? That he would put half of the money in one company. And why would he do that? Well, it didn't start that way. He invested in Apple and then the stock grew a lot. It was at least quadruple from the time he started in buying shares in Apple. So, and he didn't sell it until recently. If you look at other investors, Li Lu, for example, another good value investor, he has about 40% in Google, divided on the A and B shares. And then I wrote here on my list, well, almost. I think it was messed up a little bit by a spell check. Who could that be? I do not know. But somebody has 1/3 in Bank of America. Who could that be? Don't remember. Or maybe could it be Li Lu who has almost 1/3? I think he has 1/3 in Bank of America. That's his second largest position. Then someone like Michael Burry, famous from The Big Short, he has 16% in Alibaba. And if you go through the big ones, the famous qualitative investors, you'll see the same pattern, that they have a lot in one company. And then we know they're qualitative. That was the point with that. Point number 4, you have to look at the pattern of their trades. Yeah, you can't just look at, status quo, the composite of it. You also have to look at what did they do historically with the different companies. It's really important. You can't just, let's say that you just heard that I said that Li Lu has 40% in Google. You run out and you buy Google shares, but you can't do that because maybe he's actually selling the position. You have to look at what he's doing. When did he buy shares in the company? Is he adding to the position or is he selling? It's really important to go back and look at historically, when did he enter? Sometimes these websites will tell you that he bought this stock for a certain price, but they don't know that. So don't invest after that number. It's just an estimate. How do we know what stock price invested when they invested and what the stock was worth at that point? We can't, because we just don't know. We only know, this is the only information we have. We know that they bought stocks in a certain company within 3 months. So what I do, if I want to have a rough idea of where he might think it's a good value, well, I go back to those 3 months and then I presume that he bought at the lowest level. So I'll take those 3 months, I'll look at how the stock developed, and I'll just note, okay, so the lowest level in those 3 months, whatever, and that is what I believe could be. It's just, a way to be sure that you're not paying too much and, trying to follow their pattern. So that's how I do it, which is, of course, it's not going to be the correct price either, but it's going to be an estimate. It's going to be a reasonable estimate that gives me a bit of a margin of safety within the margin of safety. Margin of safety, what's that? It's just a way to say that you are buying the stocks cheaper than the value of the company. So point number 4 is, I actually think we reached point number 5, is Oh, of course. You have to research the trades. And there is no way to get around it. If you want to figure out if a company is a good investment, you cannot just copy. You would have to use your brain power and start researching. And how do I actually do this? So you've got all these investors, you've got all these companies. So what's a way to approach it? This is how I do it. I have a spreadsheet, and it's a really simple spreadsheet. What it helps me do, it helps me skim these companies. Meaning I'll quickly look if the numbers look, if it's something I want to look, if the numbers look okay on a very superficial level, if it's something I want to dive into. This spreadsheet will make me plot in very basic things. Is the revenue growing over, for example, 5 years? Then I just plot in yes or no. And I made this spreadsheet in a way so when I write yes, it turns green, and when I write no, it turns red. And I do it with some measures for profitability. Are they making money? And whatever measure I use for profitability, is that number also growing over 5 to 10 years? Yes, no. I also check equity. First of all, the equity has to be positive. We do have cases of companies that are growing revenue, growing profit, but the equity is negative, and that's not good. Shortly, let's just talk about equity. What does it mean? It means whatever capital is accumulating inside of the company. We want that to be positive. Theoretically, the stock price should be growing with the equity at the same rate as the equity is growing. So it's a really important number, actually, for us to look at. So what does it really mean? Well, if we look at a person, and let's say that they have a lot of debt, they have mortgages, they have student debt, maybe some credit card debt and consumer debt, and then so that's the debt that's gonna, suck money out of the equity in this calculation. And then they have something that's worth something. Maybe they own a house, maybe they have a stock portfolio. If the debt is bigger than whatever the value of the house and the stock portfolio, they have a negative equity. And just like that's not great with a person, don't marry that guy, whatever, just kidding. That's not great for a company either. We want it to have a positive equity, and we want that equity to be growing. So we check that positive, negative equity. It's not that often that companies with a positive, that are growing with the earnings and the profitability is growing, that they have a negative equity. But I have, for example, it happened to Starbucks. It happens. So we want to make sure that, we can check these things off. Then the free cash flow should also be positive. So whatever. So these very basic things, we're just skimming it. We're not even researching it yet. I'll have a list of maybe, 50, maybe even 100 companies that are recent purchases of the best value investors in the world. And I will ignore all the ones that turn out red, and I will dive deeper into the ones that turn green. And this is where I use the checklist. And the checklist is necessary, I would say. So who should you look at? There are a lot of people on the list, and this is not going to be a comprehensive deep dive into the value investors of the world. I'll just give you a few names. We can do a more deep dive in another podcast in the future. So who should you look at? Well, first of all, Warren Buffett, of course. That's a no-brainer. I think also Bill Ackman could be really interesting to look at. Now, Warren Buffett and Bill Ackman, they are so different in the way that they invest. And this is really important to keep in mind as well. Warren Buffett, he will usually be a buy and hold guy. He's a collector. He invests in company like somebody who collects art, like he keeps them. And occasionally he does sell. He has sold a bit of, a lot actually, of his Apple shares, for example. Another very strong characteristics of the way that Warren Buffett operates is he does not interfere with the companies. And usually he will also invest in companies where the moat around the company is so strong that they will even survive a mediocre or even a bad management. Bill Ackman is really different because he's an activist investor. What does that mean? It means he has an opinion, and he often invests in company with a bad management even. And then he goes on the board and he wants to change the management, and he wants certain policies to be addressed and changed. So he will go into companies where the stock price has fallen because something is not handled well, and he will fix the situation. So he's a lot more, I'd almost say, hostile sometimes. That's how it comes off. It's probably not always, but he does have an opinion about a lot of things. And you can go check out his X, and he will have an opinion about how universities should be run, how anti-Semitism is not okay, and about a lot of things. So he really is into the company. And what does this mean? Well, it's both good and bad. It means that when you're investing alongside Bill Ackman, there's someone there fighting for things to be right. But the bad thing is if you don't agree with what he wants to change, because it will probably happen. And also, sometimes he gets into some pretty edgy situations because he can come across as a little bit hostile. Who else? Li Lu, who is Chinese, famous for being the student leader of the Tiananmen Square, fled China, went to study in the US, and somehow, this is what the legend about him, this is what it's built up around, that when he was a student in the US, he made his student debt into $1 million. I don't know if it's true, but that's what they say about him, by being a value investor. He became really good friends with Warren Buffett and Charlie Munger as well. He's really, really interesting. He's not very public at all. Manish Paprai, Indian American. He wrote the book, The Dando Investor. You'll usually not see a lot of companies in the files because he trades or he buys. I don't like the word trade. That's why I'm stopping myself. Trading is usually someone who buys and sells. So investing is someone usually who will invest, he will buy the shares and stick with it, at least for a longer time. So let's use the word investing. Manish Paprai also invests in companies in other countries. And the CSC files will not show that. So it will not turn up on GuruFocus or Dataroma or whatever website you use, that he is also investing. For example, he's public about that he's also investing in Turkey. But very interesting to look up. And his book is really good as well. Then you have Guy Spear, who doesn't invest very often. So there's not a lot of activity. But interesting if there is activity, it's really worthwhile looking into what he's doing. He also wrote a book, The Education of a Value Investor, who's worthwhile reading in order to become a better investor. Then you have someone like David Einhorn, who is also a bit of a legend because he's made some really extraordinary calls. But for many years, he's had a negative return. And why is that? He is shorting a lot, and that is very difficult in a market with such a long bull market. Shorting is something we can talk about in a future podcast. Bill Ackman is also sometimes shorting, and he also lost some money because he was shorting, and he got into some pretty spicy situations earlier. The last short he did was he shorted the whole market just before the whole lockdown situation in 2020. He could see the COVID lockdown coming, so he bet on that. That was really quite extraordinary. He's quite famous for that. What's the problem with shorting? The problem is that if the stock keeps going up, there is no limit to how much you can lose, basically. How does shorting work? Shorting works like you're borrowing the shares. Let's take an example. Let's take an example from a completely different life situation. Let's say your friend is going traveling and he just bought a really nice car. It's a brand, whatever, Porsche, whatever, and it's worth 100,000 euros or dollars. Doesn't matter, just 100,000. And he asks you, could you please look after the car? It's super new. Don't scratch it. And I'll be back in 3 months or whatever, in a year. He's working somewhere. What a nice friend, huh? Well, now, you know that there's a problem with the car. Not just this car, but the whole production line has, I'll just make up something, the brake doesn't work. And you know this is going to break. I don't know how you know. Doesn't matter to this story. The story, so what you do, because you know there's a problem, you know it's going to come out, so you are betting on that the value of this car is going to fall. So you decide to short it. What you do is you sell the car quickly, so you get 100,000 for it. And then you just wait. The news comes out. And yes, the brakes do not work. And yes, the value of this car, no one wants this car anymore. So now you can buy a brand new one for 50,000. You buy it back before your friend comes home. And then you just made 50,000, right? Because you had a car, it was worth 100,000. You sold it for 100,000. You waited a little bit, something happened, the price went down, and then you bought the exact same for 50,000. So you made 50,000. Now let's say, and this of course is not going to happen with cars, but let's say that the price of it explodes. This happens with stocks. There is no limit to how high it can go, especially, we've been through a really weird period where you had things like meme stocks. All of a sudden it exploded. So let's say all of a sudden the car, which won't happen with a car, I know, is you can only buy it back for 1 million. Oof. This can happen with stocks. And you have to buy it back before your friends come back, because when you're shorting, there will be a time frame, and the further the stock goes up, the more you'll be pressured to do something. So let's say now you have to buy it back for 1 million. And, you just lost 900,000. Ow, that's a lot. So that's the problem with shorting. So, but that was a little side note. One last investor could be Michael Burry, who's famous from The Big Short. And he basically made a very famous short betting on that the financial crisis would happen. Thanks for listening. If you liked this episode today, please follow, like, and review it. It really helps the podcast grow. If you have any question, feel free to hit me up on X or LinkedIn. My handle is Beile, my first name, Beile.